The global financial economic system, the world's largest casino, warns that the following content may completely change your perception of this world. Be prepared to face the naked truth and discover the secrets that those in power try their utmost to conceal, because the information you are about to receive can not only change the course of your life, but also help you gain an advantage in this global financial game. Imagine a colossal casino with dazzling neon lights, resounding cheers, and the endless sound of money flowing in. Be ready to accept an astonishing truth. This casino is the global economic system we live in and depend on. From the moment you were born, you have been a pawn in this massive gambling machine. But there is a fatal flaw in this casino. The rules are set by a select few big entrepreneurs, politicians, and financial tycoons who stand at the top of the pyramid. They not only establish the rules, but also ensure they remain in an unbeatable position. Let us examine the 5 levels within this casino. Level 1, big entrepreneurs who maintain the current world order. Level 2, startup entrepreneurs striving to change the world. Level 3, hardworking employees with stable incomes. Level 4, stock investors aspiring to get rich, but only able to speculate. Level 5, lottery players who leave their lives to chance. Which level are you currently at? Most people might be at level 3 or lower, but remember, this is not a fixed fate. Understanding how this system operates gives you the chance to break free from the mold and climb the social ladder. Before we delve deeper, don't forget to follow the channel for more truths about money and to help you achieve financial freedom. Quickly, welcome dear viewers and friends. Let us analyze some lesser-known rules in this game. These rules are like invisible chains that bind most people while creating endless opportunities for a select few. Rule number 1, the power of money making. Money. The rich can continuously accumulate wealth thanks to the power of compound interest. Albert Einstein once called compound interest the 8th wonder of the world, and this is no exaggeration. Simply put, compound interest is when your money generates more money, and that money continues to generate even more, creating a positive cycle. For example, suppose you start with 100 million as capital, and each year your money grows by 10% through compound interest. After 30 years, you would have over 2 billion, but if you add 1 million each month, after 30 years, you would accumulate more than 4 billion. This is the core reason why the rich keep getting richer. But there is a cruel truth. Inflation is eroding your wealth. If your money does not grow faster than inflation, you are actually getting poorer. That is why keeping money in a bank savings account is one of the worst ways to manage your finances. Rule number 2, risk and return. In this financial casino, high returns always come with high risks, but the truth is the top players know how to shift risks onto others while reaping the rewards themselves. The 2008 financial crisis is a classic example. Big investment banks orchestrated a massive scam, turning high-risk mortgages into seemingly safe investments and selling them to unsuspecting investors. When the bubble burst, these banks pocketed enormous profits, while ordinary investors and taxpayers bore the losses. Rule number 3, information asymmetry. In this game, information is everything. Those at the top of the food chain always get critical information before everyone else. That is why, despite insider trading being illegal, it still happens in practice. Imagine a scenario where a tech company CEO leaks to a friend that they are about to launch a revolutionary product. The friend quickly buys a large amount of stock, and when the news breaks, the stock price skyrockets. The friend easily makes millions, while ordinary investors can only watch and regret or jump in at the peak as early investors sell off. Rule number 4, leverage. Leverage is a double-edged sword. It can multiply your profits many times over, but it can also leave you penniless in an instant. Financial elites excel at using leverage, balancing risk and reward. For instance, in real estate, smart investors often use bank loans leverage to buy property. Suppose you put down 2 billion to buy a 10 billion house. If the house price rises by 10%, your actual return is 50% because you only used 2 billion of your own money. But beware, leverage also amplifies losses. If the house price drops by 20%, you lose your entire down payment and end up in debt. This is why extreme caution is needed when using leverage. Rule number 5, psychology in finance. The market is not always rational because it is made up of people, and people are driven by emotions. The 2 main emotions influencing the market are fear and greed. Smart investors know how to exploit this. For example, when the market panic sells, they buy good assets against the trend. When the market is overly optimistic, they take profits at the right time. Warren Buffett's famous saying, "Be greedy when others are fearful, and fearful when others are greedy," perfectly illustrates this principle. Understanding and controlling your emotions while capitalizing on others' emotional swings is the key to success in the financial market. Next, let us talk about the 5 levels in the global economic system. Level 1, big entrepreneurs. At the top of the pyramid, we see not only successful business leaders, but also those who set the rules for the entire economy. These big entrepreneurs possess enough resources and influence to dominate entire industries, or even the whole economic system. They do not just participate in the game, they continuously redefine the rules. Take Jeff Bezos, the founder of Amazon. As an example, his business empire did not just completely change the retail industry, but also redefine the concept of modern business. Through technological innovation and evolving business models, Amazon's strategy of taking losses to capture market share, using long-term deficits to dominate, has left many traditional retailers unable to compete. This approach seems to benefit consumers, but it is actually a powerful way to monopolize the market. When accused of monopolistic behavior, Amazon cleverly argues they are just providing better services to customers. This sounds reasonable, but it hides a truth. By lowering prices and offering seemingly superior services, Amazon is stifling competition, which could ultimately reduce consumer choices and drive prices higher. The real secret of big entrepreneurs is their ability to socialize risks and privatize profits. When they make money, the profits are entirely theirs, but when they face losses or crises, they can convince the government to bail them out, and ultimately the public bears the cost. The bank bailouts after the 2008 financial crisis are a prime example. Before the crisis, big banks chased profits recklessly, but when disaster struck, they claimed they were too big to fail and received rescues. Even more surprisingly, many large corporations actively lobby the government to enact regulations that favor them, blocking potential competitors from entering the market. This activity, euphemistically called industry self-regulation, is actually a way to prevent competition. They claim to protect consumer interests, but they are actually erecting legal barriers to safeguard their market position. This explains why in some industries that seem fiercely competitive, a few large companies often dominate for a long time. Big entrepreneurs also master the art of shaping social trends. They control the media, fund research institutes, and sponsor academic projects to influence public opinion on certain issues. For example, they might heavily promote the concept of corporate social responsibility, portraying themselves as guardians of societal interests. However, these activities are sometimes just to gain tax breaks or improve their public image. Additionally, big entrepreneurs often possess a vast network of relationships, including key figures in politics, business, and academia. These connections help them receive support in difficult times and quickly seize opportunities when they arise. Ordinary people may struggle their whole lives to build such a powerful network. Finally, it is worth noting that this class often has an extremely high tolerance for risk and a long-term vision. They can accept significant short-term losses as long as they see substantial long-term profits. This way of thinking enables them to innovate boldly and invest, which is the key to maintaining their leading position. Look at Vingroup's development of VinFast in our country, and you will understand. Level 2, startup entrepreneurs. Startup entrepreneurs are often portrayed by the media as brave risk-takers and potential future big entrepreneurs. However, the reality of starting a business is often much harsher than imagined. According to many studies, over 90% of startups ultimately fail. So how do successful entrepreneurs stand out? The truth is, many so-called unicorn companies, startups valued at over $1 billion are actually burning through investors' money. They use subsidy and discount strategies to quickly capture market share. Their goal is often not profit, but rapid growth followed by an exit at a high valuation. This is why you see companies that have never been profitable yet are worth billions of dollars. Uber is a classic example. For many years, Uber has been losing money, but its valuation keeps rising. Why are investors willing to keep injecting capital into a losing company? Because they believe Uber will dominate the ride-hailing market, and once it does, it can raise prices at will to reap enormous profits. This strategy is called winner takes all, meaning the final winner in a market will capture nearly all the profits. However, for most ordinary startup entrepreneurs, this strategy is extremely dangerous. Without strong capital backing, most startups cannot withstand prolonged losses. This is why many startups die young. They may have good ideas, but lack sufficient capital to get through the initial loss-making phase. Startup entrepreneurs also face another harsh reality: the rapid changes in technology and the market. An idea that seems innovative can be replaced in just a few months by new technology or business models. For example, franchise businesses were once a hot startup trend, but quickly declined due to oversaturation and management issues. Moreover, startup entrepreneurs must contend with pressure from large corporations. When a startup project shows potential, large corporations often quickly enter the fray, using their resource advantages to dominate the market. For instance, when a new feature in a social app becomes popular, large social platforms quickly integrate that feature into their products, posing a significant obstacle to the growth of smaller companies. Despite this, entrepreneurship remains a crucial driver of innovation and economic development. Successful entrepreneurs often share several key traits: sharp market perception, the ability to learn and adapt quickly, excellent team management skills, and unwavering perseverance. They can learn from failures, grow through adversity, and persuade investors to believe in their vision. Level 3 office workers. In the middle of the pyramid, we see the largest group: office workers. They often consider themselves the backbone of society, believing that through hard work, they will have a stable life. However, reality shows they are running on an ever-accelerating treadmill. The first challenge office workers face is continuous inflation. Although nominal wages may increase, real purchasing power can decrease. Soaring housing prices make it difficult for many, even after years of work, to buy homes in major cities. Rising education costs cause anxiety about their children's futures. These factors continuously erode the income and quality of life of the office worker class. Even more concerning is that with the rapid development of artificial intelligence and automation, many traditional office jobs are at risk of being replaced. A report by the McKinsey Global Institute indicates that by 2030, up to 800 million jobs worldwide could be replaced by automation. This means that those who think their jobs are stable may soon find their skills outdated. For example, in finance, many analyst and trader jobs have been replaced by algorithms and AI systems. In law, AI is gradually taking over basic document review and legal research tasks. Even in medicine, the accuracy of AI diagnostic systems in some areas has surpassed that of doctors. The harsh reality is that in modern businesses, most employees are seen as replaceable resources. When companies need to cut costs, layoffs are often the first option. That is why the concept of lifetime employment has become a thing of the past. In this environment, office workers must continuously learn new skills and enhance their irreplaceable value to remain competitive in the labor market. Office workers also face the challenge of work-life balance. The development of technology means work can appear anywhere. Many people find it hard to truly disconnect after work hours. Long hours, high pressure, and lack of rest time not only affect physical and mental health, but can also strain family relationships. Additionally, the office worker class is being squeezed from both sides. On one hand, they must compete with younger entrants who have updated skills and knowledge. On the other hand, it is difficult for them to climb to higher management positions because those positions are limited and highly competitive. Faced with these challenges, many office workers have started seeking side jobs or entrepreneurship in hopes of gaining extra income and increasing their sense of financial security. However, this brings new pressures and risks. Overall, the office worker class is living in an era full of uncertainty and challenges. To maintain competitiveness, they need to continuously learn, adapt to changes, and find ways to balance work and life. Those who can face and overcome these challenges will have the opportunity to find new opportunities, while those who cannot adapt will face the risk of being eliminated. Level 4 stock investors. In the food chain of the financial world, stock investors are often seen as grass, those who are exploited and suffer repeated losses. Although this metaphor is bitter, it is not entirely untrue. Most stock investors think they are investing wisely, but in reality, they are betting in a giant gamble. The rise and fall of the stock market often has little to do with the true value of companies, but is determined by complex factors, including market psychology, unexpected news, policy changes, and even malicious manipulation by large capital. In this world of information asymmetry, ordinary investors are usually the last to know the truth. Consider a shocking statistic. According to investigations by reputable research organizations, over 95% of day traders ultimately lose money. This number is startling, but not surprising. Why? Because small retail investors are essentially gambling against financial institutions that possess insider information. Advanced high-frequency trading systems and abundant financial resources. This is like a sheep trying to survive among a pack of wolves. The outcome is predictable. Worse still, many small investors fall into a vicious cycle called buy when prices rise, sell when prices fall. When they see a stock continuously rising, they fear missing out and buy in at high prices. However, when prices start to drop, they panic at the risk of loss and hastily sell at low prices. This behavioral pattern is what large institutions love because they can exploit the panic of small investors to buy low and then sell high to those driven by emotion. Many small investors are also easily lured by so-called insider information. They delude themselves that with a few tidbits of information, they can gain an edge in the market, but real insider information does not easily reach ordinary investors. Most of the time, these rumors are just hearsay or deliberate smoke screens released by large institutions. Another common trap is overconfidence. Some investors, after one or two successes, believe they have understood the market's rules and start increasing their investments significantly, even borrowing to invest in stocks. However, they forget a simple truth: short-term success may just be luck, not skill. Additionally, some investors place too much faith in technical analysis, spending a lot of time studying price charts and indicators. They believe they can predict stock price trends through these charts, but overlook an important factor: past performance does not guarantee future trends, especially in a market manipulated by large capital. So are small investors certain to become grass? Not necessarily. The key is to change your mindset and investment strategy. First, understand that stock investing is a long-term process. Do not expect quick profits from short-term trading. Second, learn to diversify risks. Do not put all your eggs in one basket. Third, continuously learn to enhance your financial knowledge and risk management skills. And finally, most importantly, recognize your limitations. You may never be able to beat institutional investors with their resource advantages, but you can choose to cooperate with them, such as investing in index funds or high-quality, actively managed funds to participate in the market. Remember, in the financial market, the biggest enemy is often not the market, but your self-control, greed, and fear. Maintain rationality and patience, and you can avoid the risk of being harvested repeatedly and become a wise long-term investor. Level 5 lottery players. At the bottom of the pyramid, we see a group that evokes pity: lottery players. Lotteries are often called the stupid tax or poor people's tax. Although this term is somewhat harsh, it is not without basis. Governments and lottery companies have cleverly exploited the dream of overnight riches to drain the money of the poor. Consider the odds of winning the lottery. Take one of the most popular lotteries in the U.S., Powerball, for example. The chance of winning the jackpot is about 1 in 292 million. What does this number mean? Simply put, you are more likely to be hit by a meteorite or become the president of the United States than to win the lottery's grand prize. Yet millions of people buy lottery tickets every week. Why? For many, especially those at the bottom of society, the lottery may be the only opportunity they feel they have to change their fate. In a world where social stratification is increasingly rigid and social mobility is decreasing, the lottery offers a glimmer of false hope. For a small amount of money, they can dream of changing their lives. This psychology, combined with humans' inherent misunderstanding of probability, makes the lottery an extremely effective tool to profit from the vulnerable. However, there is a harsh truth that few know: even if you actually win the lottery jackpot, it may not necessarily be a good thing. Many studies show that many big winners end up with a worse quality of life. Most of them, due to a lack of financial management knowledge, quickly squander the money. Some are changed by sudden wealth, alienating friends and family. Others are relentlessly pursued by acquaintances, even facing extortion and threats. Even more astonishing is that some big winners end up in worse financial situations than before they won. They become accustomed to a luxurious lifestyle, but when the prize money runs out, they cannot maintain that way of life. Some even accumulate large debts and have to declare bankruptcy. This is why we often hear stories of lives becoming dead ends after winning the lottery. The lottery also has another hidden danger: it can lead to gambling addiction. For some, buying lottery tickets may just be an occasional form of entertainment, but for others, it can become a hard-to-break addiction. They may spend more and more money on lottery tickets, always deluding themselves that the next ticket will change their fate. This behavior not only causes personal financial damage, but can also lead to serious psychological problems and family conflicts. Nevertheless, despite these obvious risks and disadvantages, the lottery remains an important source of revenue For many countries, governments often allocate a portion of lottery profits to public sectors like education and healthcare, giving the lottery a certain level of legitimacy and morality. But we still need to ask, is this subtle exploitation of the poor's hopes truly serving the public interest? Finally, it is important to recognize that true wealth accumulation is a slow and steady process. It requires knowledge, skills, effort, and time. Hoping to win the lottery, an almost impossible event, is not only a waste of money, but can also cause you to miss real opportunities to improve your life. Instead of dreaming of getting rich quickly, you should use that money for education, skill training, or starting a small business. These choices may seem mundane, but they are more certain paths to changing your destiny. In this global financial game, psychological factors often matter more than cold numbers. Understanding and controlling the following psychological factors will help you gain an advantage in the game. First, loss aversion. People often feel more pain from losses than pleasure from equivalent gains. This is why many investors stubbornly hold on to losing stocks, but quickly sell winning ones. Recognizing this can help you make wiser investment decisions. Second, the anchoring effect. When making decisions, people often rely too heavily on the first piece of information they receive. For example, when seeing a stock drop from 100 to 50, many think this price is cheap, but in reality 50 may still be overpriced. Always base your decisions on intrinsic value, not on a random price level. Third, herd mentality. The herd effect is very common in financial markets. People tend to follow the crowd. This is why investment bubbles occur. Developing independent thinking, not following the market's emotions, can help you see opportunities when others are fearful and stay sober when others are excited. Fourth, confirmation bias. People tend to seek information that supports their existing views and ignore contradictory evidence. In investing, this can make you overly optimistic about your current investments. Learn to actively seek counterarguments to make more balanced decisions. Fifth, overconfidence. Many investors, especially after a period of success, become overconfident and underestimate risks. Remember that the market is always changing and past success does not guarantee future success. Always remain humble and vigilant. Now that you understand the hidden aspects of this financial game, you have two choices: continue to be a passive participant controlled by the system, or use this knowledge to actively shape your financial future. Remember that knowledge is just the first step. Real change comes from action. Start planning today and take steps to implement it. You may not be able to change the entire system immediately, but you can certainly change your position within it. Finally, I want to remind you that this game never stops, and its rules are constantly changing. Always stay alert, keep learning, and be ready to adjust your strategy. This is not a short race, but a marathon. Are you ready? Because from now on, you are no longer a passive spectator, but an active participant in this global financial game. Remember, in this game, you either master it or it masters you. The choice is yours. Now open your eyes and see the truth of this world, because only when you truly understand the rules of the game can you begin to win. Move forward. The future belongs to those who dare to challenge the present, continuously learn and adapt. You are one of them.